Okay, first problem for chapter 4 is M43. M43 asks us to look at some transactions and figure out whether or not an accrual adjustment is required or a deferral adjustment is required. When trying to decide between the two, one of the things that you can do is ask yourself the question, has there been a previous journal entry made, right? With a deferral, something has been placed on the balance sheet. The expense or the revenue has been deferred by placing something on the balance sheet. The deferral adjustment then takes it off of the balance sheet and moves it onto the income statement, either via revenue or via expense. Let's look at a quick example here. If you look at supplies, when we initially buy supplies, we debit supplies, okay? We'll put just random amount. And then credit cash if we paid for it in cash. You could also buy it on account, in which you would credit accounts payable. This journal entry places supplies on the balance sheet, right? On the balance sheet. Supplies are going on the balance sheet. And we had a cost that we actually paid. We paid this cost, but we haven't yet incurred an expense. Why? Because we haven't yet used up the supplies, okay? As we use up the supplies, we would debit supplies expense. That is the point in which we actually incur the cost. We talk about this concept of matching principle. We match the expenses with the revenue, okay? The expenses have to follow the revenue. At this point, we've bought supplies, but we haven't used them to generate revenue, right? We haven't used them. As we use them, we would think in theory that we would be generating revenue. So as there's revenue created because we're using our supplies, then the expense should follow that revenue. So in the period in which we use the supplies, we would debit supplies expense and then credit supplies, okay, to remove it from the balance sheet. This takes it off the balance sheet here and places it to the income statement, okay? Expense goes on the income statement, supplies are from the balance sheet. So we're removing from the balance sheet. Initially we put it on the balance sheet. We're removing from the balance sheet and placing it onto the income statement for a random amount here. Okay? This is one example. You could also have an example with revenue. For instance, let's take, we receive some cash, but we haven't yet done anything for that cash. We haven't earned that cash. So we have unearned revenue. Just a random amount. Again, this places unearned revenue on the balance sheet. It's not an asset, but it shows up as a liability, right? So you're taking that portion that could have been revenue, but we haven't yet earned it, and placing it on the balance sheet. You're deferring the revenue until you actually earn it. Then the journal entry for the deferral journal entry would instead be, once we earn the revenue, debit unearned revenue and credit some sort of revenue. This takes unearned revenue off the balance sheet and then places revenue on the income statement, okay? So these are deferral adjustments. You ask yourself, has there been a previous journal entry? This being the initial journal entry and then requiring a adjustment, the deferral adjustment. With accruals, there's been no previous journal entry. There's been an event that's taken place, and that's why it requires an adjustment, but there's been nothing that's been previously set on the balance sheet that's been deferred. We instead have to make a journal entry to recognize the event that's happened during whatever period that we're looking at, okay? So let's use this information to solve the problems that we're looking at. The first one says supplies for office use were purchased during the year for $500, of which $100 remained on hand at the year end. Well, that was the first example we've done. We know that the original journal entry debited supplies, placing it on the balance sheet. We now require a deferral adjustment. Why? Because we started with $500, we only have $100 left, so we have to make a journal entry to recognize the $400 that's been used. All right, the next, it says interest of $250 on a notes receivable was earned at year end, although collection of the interest is not due until the following year. In this instance, we have an accrual adjustment. Why? There's been an event that's happened. We've earned interest, right? But there's been no previous journal entry that's taken place, not like there was with the supplies account here. It simply tells us that interest of a $250 on a notes receivable was earned at year end. It doesn't tell us that we have something that's previously been recorded, okay? So there's been no journal entry that's been made. We simply now have to make the adjusting journal entry. It does require an adjusting journal entry because we've earned interest and it hasn't been recorded, okay? But there's been no previous journal entry that we need to adjust. So this is an accrual adjustment. The next one, at year end, wages payable of $3,600 had not yet been recorded or paid. Again, not yet been recorded or paid, no previous adjustment, but because we have wages payable at year end of $3,600, okay, we need to record that. Because we have wages payable, we know that we have a wage expense, right? Someone must have worked. Otherwise, why would we have a wages payable? Why would we owe them money? Someone must have worked, so we have some sort of need to record the expense that we've incurred. They've provided us services, we've incurred an expense. We debit wages expense, credit wages payable, okay? Next. At year end, 1/2 of 2,000 advertising project had been completed for a client, but nothing had been billed or collected. Again, we're looking at an accrual adjustment, right? There's nothing that's actually been recorded in a journal entry, but have we earned revenue? Yes. Have we earned all the revenue? No. It tells us that we've completed half. It says we can 1/2 of a $2,000 advertising project had been completed for a client. So we haven't earned all the 2,000, but we've earned half of it, and therefore we can record that under an accrual adjustment. And the last one, number 5, it says redeemed a gift card of $600. This would be B, deferral adjustment. Why? That was our second example that we showed over here, in which if we received a gift card, we would have previously debited cash, credited unearned revenue, until that gift card was redeemed. Well, in 5, it tells us that they redeemed the gift card, therefore it requires a deferral adjustment. Remember, adjusting journal entries are made at the end of the period, and if they're a deferral, they're adjusting a previous balance that was set up. If they're accrual, there was no previous journal entry made. Please let me know if you have any questions over M43.